Alright, next thing, we got to talk about internal controls and record retentions in our payroll system. So we need to have some sort of verification of time cards. Typically managers sign or approve or do something like that. Verification of payroll computations, not so much of an issue anymore. I mean, once you've plugged in somebody's hourly rate or something to that extent, as long as the hours are good, they'll manage to flow through. I should probably turn that alert off. Alright, and then the approval, so some sort of approval of pay amounts, and then preparation of pay disbursement. Typically with a direct deposit, you need to get that file to the bank early. So if payday's a Friday, they'll typically say, we have to have that file to us Wednesday by noon. Your bank will tell you. Or checks need to be signed, or there's a preparation that you'll need. And then somebody typically approves the pay being sent out. File security. So typically when you're sending files to the bank, it's part of the internal control. The government also has some safeguards. So there's typically, a couple of passwords you have to enter. When I did it, there was a password, and then I would get a verification number would be texted to me, and I'd have to enter that. Personnel, cross-trained, got to have the encryption. Typically, payroll, there's restrictions. So the person who enters hours is not the same person who sends the direct deposit file. Bigger businesses, bigger companies, you want to spread out the responsibility. You also want to rotate duties, because again, that's a good way to find if somebody has been doing some fraudulent things. If you keep them in the same job over and over again, then they can have a chance to do some less than desirable things. Here's an example that the textbook pulls up. A payroll specialist discovered that they were sick with HIV, so he took the money from his employer. He created ghost employees, and then he routed it to his payroll account, to his bank account. So yeah, he definitely a lack of segregation of duties in this case. Guy was able to put people on the payroll, fictitious people, get them paid, take the money. IRS gives some guidance regarding employer regulations regarding payroll files. You have to, got to keep the files, you give recommended storage and backup, and you need to give auditors access, definitely for publicly traded companies, but privately held companies as well. If a government agency wants to look at your records, you need to show them. You have to keep the records during the duration of employment for employees. You must, give a payroll transaction detail. You need to have records of executive pay, and pay needs to be benchmarked and justified. So a closed system, you only have access to a few people, and you know who's logging in and out of that system, who's doing what, and IT especially is making sure we didn't get spearphished. Somebody didn't click on a link that they shouldn't have. So you want to have more people involved. You don't want a solo effort with payroll. So you don't want, the same person who enters hours should not be the same person who generates the direct deposit file. That smaller businesses, that doesn't always work out, but it's a good practice. So what a solo non-payroll department prevents: continuing to pay people who've terminated, tinkering with sales commissions. Just a lot of bad things can happen. Document retention, manual and computerized records, doesn't matter. IRS says you got to hang on to them for at least 7 years. And retention period begins upon the final pay distribution. What that means is somebody quits, you got to maintain their records for 7 years. In the event of payroll fraud, you need to keep it indefinitely. And the employer is responsible even if you use paychecks or ADP. So 2012, there was a court ruling and regard to the IRS statutes of limitation and audits and guidelines about record audits, 3 years to assess taxpayers' deficiency. So this would be the company making payroll deposits. 6 years if the taxpayers' gross assets were understated by 25%, and there's no statute of limitation if you are intending to create a fraud. Alright, I'll upload this video and we will finish with the last portion of the chapter.